Hey guys, I'm the Newb investor. Today we'll be screening Adobe, ADBE, through our three metrics to see what are our best entry prices for the stock. Adobe is currently trading at 452.13 with highest price of 699.54. That's 35.37% of the highs. Current market cap of 213.27 billion with PE ratio of 45.1 with EPS trailing 12 months of 10.02. They don't give out dividends. First metric, we want an EPS lower than 3. It's 4.5. We get this by dividing the current PE by the EPS. This metric tells us how much we're paying for the stock based on their current earnings. It also shows the proportion of their net income to shares. I've included here the EPS history and outstanding number of shares. We want EPS increasing and OSN here is decreasing. Second metric, we want to pay $1 or less for 1% of the money they're making. We determine that by taking the lowest yields of both the net income and free cash flow yields of the current year and the averages of 5 and 10 years of data. The more data, the better. But in this video, we'll only be using 5 years of data just to show you our process. Looking at the table, this is the revenue deconstructed. The costs, the expenses, and the income they get from those revenues. I'll show you the relationship of the sales. In 2021, they spent 1.865 billion in COGS to make a revenue of 15.785 billion. That's 11.82% of the total revenues. In average, they spend around 65% of the revenues to costs and expenses and keep 30 to 40% of revenues as net income or free cash flow. We take the lowest yield of the four highlighted values, which is 29.95, and we'd use it to divide the current PE, and we'd get a discount of 1.51. Meaning if you're buying the stock at these prices, we'll be paying 1.51 times their yields or margins. But if we're using the current year's yields, it is currently trading around fair values. Why do I include the net income, not just the free cash flow? I thought net income is also important as the EPS is based on it and not on the free cash flow. Why do I take the lowest value? I take the lowest value to have a baseline for our assumptions as we don't want to pay at a higher PE. I've also included here the revenue growth as this second metric does not account for the values of the revenue. Even with declining revenues, they will still make the same yields. So it is important that they maintain or at least retain their revenues. Adobe is trading at a premium right now based on this metric. Third metric, we want to know our discount compared to when the markets have valued the stock before. I have here two historical data, one from Guru Focus, which is readily available, and one from the macro trends, where I took the average PE manually, where the stock traded in a range of consolidation before. We'd see here the highs and the lows of PE traded before, and the numbers of quarters I took the PEs from. We'd only use the lowest average PE as we want to base our assumptions at the lowest PE. In this case, we'd use 51.61 to divide the current PE of 45.1, and we'd get a discount of 0.87, meaning it is currently trading at a lower PE now compared before. In conclusion, the stock beats one of my three metrics. I'd say the stock is trading at overvalued prices based on my second metric. I don't own the stock. This is my honest and humble opinion on the stock. Should you pay premium for the stock? Absolutely. The revenue is growing. Is it a multiple of 1.5? I don't know. It's a personal preference and it all depends on your risk appetite and your returns, I wouldn't buy the stock now. I think the fair value of the stock is around 300. This is when you multiply the lowest yield of 29.95 with the current EPS of 10.02. I don't promote buying stocks at a premium and I don't buy stocks at a premium. But if you really want to buy the stock, here are my multiples. If you think Adobe can grow 10% their revenue from here to some point in time, use a multiple of 1.25. 1.5 for 20% growth, and 1.75 for 30% growth. Again guys, I don't promote using multiples as this is why you see stocks plummeting when analysts' expectations are not met by the company. Here are my entry prices with multiples. This three metric I use is designed to determine the best PE to buy a particular stock. as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.